me tell you what I hear every single week. A business owner messaged me, Rubina, my company made good money, but I have paid tax in the company and then again when I take it out, like HMRC's taking it twice. I check their accounts. Same problem every time. Wrong withdrawal order. So today my traffic light system where you can withdraw the money tax efficiently and keep HMRC out of your pocket. A quick note. This is education, not advice. Rules vary. Your situation matters. By the end, you will know the best order to extract from your limited, what is free, what is cheap, what is risky, plus a real life example. And if you are running a UK limited company, then subscribe. The people who save tax don't do magic, they do structure. Now the traffic light system. Green is for free, tax efficient, clean, no drama. Amber is for cheap, not zero, but smart. Use after green. Red is risky. HMRC spotlight schemes, audits, avoid. So goal is maximum green, then amber, and then never go for red. Green, the free zone. Most directors do this backwards. They pay themselves personally, pay tax on the income, then buy things they needed for the business. That is what I called a you problem. I want it to become a company problem. Because if the company pays, you often avoid paying tax on money before you spend it. Item 1. Mobile phone. If the contract is in the company name and the company provides you the phone, this is usually one of the cleanest exemptions. It is simple. Company pays, business expands. You are not taxed personally just because you used it. Item 2. Relevant life insurance. A lot of directors want life cover. Normally, that can trigger benefit in kind issues, but relevant life can be structured as a tax efficient policy through the company if it is set up properly. Item 3. Trivial benefits. Small gifts under £50 can be paid by the company without triggering personal tax. And yes, directors can use this too. But there are limits and rules. And yes, HMRC love the details, so keep it tidy. Item 4. Mileage on your personal car for business journeys. If you use your personal car for legitimate business travel, the company can reimburse mileage, and that reimbursement can often be a clean way to extract money tax-free because it is repayment of cost, not income. Important. Commuting is not a business journey. Think visiting clients, going to a site, traveling to court, a job. Item 5. Working from home allowance. If you work from home, there is a simple fixed rate claim many directors use to cover home running costs. It is not sexy, but it is clean, repeatable, and adds up. Item 6. Employer pension contributions. This is one of the most powerful moves in the funnel because done correctly, it reduces company profit, so potentially less corporation tax, and it is not treated like personal income in the same way salary is. So your allowances can be used elsewhere. This is especially important for directors who want to build long-term wealth without triggering extra personal tax today. Mini recap. If you only remember one thing, green is where the easy wins live. Amber, the cheap zone. Efficient but not free. Salary, why it is green/amber. Now let us talk about the big one. How to pay yourself. Most directors use a combination of a small salary and dividends. A small salary can be efficient because it creates a company deduction. It can help with state pension qualifying years depending on level, and it uses some of your personal allowance. But salary can trigger employer NI and admin, so it is often not fully free. That is why I call it green/amber. It is good, but the sweet spot depends on your setup. Amber item 1, dividends. Dividends are still one of the most efficient ways to extract profit because they are not subject to national insurance like salary is. The key idea: you typically want to use your lower tax bands intelligently, especially if your goal is to avoid pushing yourself into higher rates faster than necessary. But dividends require profit, proper paperwork, and good bookkeeping. This is where I will just take money out becomes expensive later. Item 2, benefits in kind only if the maths wins. Most company pays for my personal life stuff triggers benefit in kind taxes, and usually it is not worth it. But occasionally something can be cheaper through the company even after the tax, depending on pricing and your tax band. That is an amber only if it fits decision. Item 3, entertaining prospects. If you take a genuine business prospect out, the company can pay. You are usually not personally taxed for that meal. It is not always tax deductible for the company, but it can still be smarter than paying from your taxed personal income. Situational strategies. Powerful but must be done correctly. Alphabet shares. High value, high technicality. Now we are lower in the funnel, not red, but definitely situational. If you have a spouse or civil partner and you share finances, bringing them in as a shareholder can allow you to use their allowances too. And if your tax positions are different, you will hear people talk about alphabet shares. The idea is flexibility in dividend allocation. Warning: this is where people get it wrong. This must be set up properly, otherwise, you drift into messy tax territory. Employing teenagers, if real. Another situational option: employing your children if they genuinely work in the business and you pay a reasonable wage for real work. That can be more efficient than paying their costs from your already taxed income. Again, it must be real work, real pay, real records. Directors' loans. Careful with timing. And then there is directors' loans. If the company owes you money because you paid personally for company costs, taking that money back is often repayment, not income. But borrowing from the company has rules and deadlines, and if you mess up timing, you can trigger nasty charges. This is not don't do it. It is do it, but with control. Real life example, simple, realistic. Number the viewers can follow. Let's do a simplified example. Imagine your company generates profit and you want to extract value this year. Step 1, green. Before you even touch salary dividends, you make sure the company is paying the things that are legitimately business, like phone, mileage, small allowable claims, and you set up employer pension contributions if that fits your plan. Step 2, green, amber. Then you choose a sensible director salary level that uses allowances without triggering unnecessary NI, depending on your exact setup. Step 3. Then you pull additional money through dividends, staying intentional about tax bands. Result: you have not used tricks. You have simply stopped doing this: earn, pay tax, and then spend, and started doing this: spend legitimately in the company, reduce profit, extract the rest efficiently. That is the whole traffic light idea. Now, is this every method of taking money out of your limited company? No, for sure. There is going to be some other ones, but these are the main, biggest, safest legal ways to take money out of your limited company. And not every method is going to apply to you. So, do your own research. If you want, I can make a follow-up video where I break this traffic light method into the best director salary strategy with current thresholds, dividends planning mistakes that trigger HMRC headaches, and the red flag list of what sounds like a deduction but is not. If that would help, comment traffic light and I will prioritize it. And if you are a limited company director in the UK, subscribe. My channel is all about simple taxes, smart business, master your money.